This is a stock analysis update for Yellowcake. Yellowcake can be looked at as a ETF for the uranium spot price. They are, however, structured as a equity, so you can just buy them with the FTSE ticker symbol of YCA.L. And the majority of their assets are about £1 billion worth of uranium oxide or yellowcake, and this is the fuel used for nuclear power station after it's been converted and enriched, of course. So yellowcake are essentially just mostly uranium oxide that they store, or yellowcake, which they store in two facilities, one in Canada and the other one in France. So that's how, by buying yellowcake, you can directly invest in the uranium spot price. Their share price is actually currently a 20% discount to NAV. So for every 100% of yellowcake you buy, you actually get an extra 20% of this commodity free. They have a long-term contract with Kazatomprom, who are the world's largest uranium miner, where they can buy up to $100 million worth of yellowcake every year. You can see here all the purchases they've made since their IPO. Now, I've noticed that they've actually held off from their latest tranche, and effectively they've got about a year in which they can make their next purchase from Kazatomprom. And I think that they're actually deliberately holding back to see what goes on with Russia. But I wouldn't let that distract you from investing in yellowcake, because the vast majority of their assets are the £1 billion worth of uranium, approximately, that they have just in storage in France and Canada. So even if Kazakhstan stopped exporting any uranium tomorrow, their share price is still a 20% discount to NAV, because they have those assets stored securely. Now, here's the uranium spot price, and I made my purchase back here in 2020, and you can see that the uranium price has been in a bull market since then. Going back to the 90s, and we had a depressed price of uranium, mainly because of oversupply and the megatons to megawatts program, which was where ex-Soviet nuclear weapons were being converted into nuclear fuel. However, when that program finished, we found ourselves in a uranium undersupply situation, which led to the uranium bubble of 2007. As you can see, this was a tremendous upside for people who owned uranium commodity. But that bubble burst, including the Fukushima accident, and uranium has been a much hated commodity for quite some years. And this was the situation where Yellowcake initially IPO'd with their first purchase of £9 million of yellowcake. And we've seen a bull market since then, mainly due to a undersupply. A lot of mines had gone bankrupt and stuff, leading to a general undersupply of uranium. Plus, there were some ETFs, Sprott Investment Trust, came in and hoovered up quite a lot of uranium from the spot market, leading to an increase in price. And the fact that in the last few years, uranium has become extremely fashionable. The governments in the West have all of a sudden leapt on uranium as a way of meeting their net zero goals, and everyone's been talking about uranium. And so in this environment, we've seen quite a nice bull market. And Bank of America have forecast a $70 uranium price next year. And I can see quite a nice linear trend here, actually, where there's been a sufficiently tight uranium market to push the price up. And this Bank of America target looks quite congruent with this linear trend up here. So here's the yellowcake share price, which does mirror the uranium spot price fairly well. And you can see this is what I bought back in 2020. And this has been a really good investment. I'm essentially pretty much doubled my money at this current point. But I've decided that I really need to have another look at uranium, what I think the future could lie for the spot price. because now that I've doubled my money fairly much, I've got to decide, do I now sell half now and cash in some of that, or is it worth hodling, as we are in kind of a fairly volatile period at the moment? Do I hodl through, because I think in the long run it could go much higher? This is why I'm doing this video, to try and work that out. Oh, that's a good point to say. Please remember that I'm just an amateur who does these videos purely because I enjoy doing them as a hobby. Always seek advice from a qualified financial advisor before making any investments yourself. So here I zoom out to the historical uranium price, and we saw that back in the 70s there was a bubble. This green line here adjusts for inflation. And back in the 70s, a lot of countries around the world were building a lot of nuclear power stations, and there was a bit of a supply underhang leading to this bubble. We had the 3 Mile Island accident and then the Chernobyl disaster. There was a lot more uranium mining taking place in response to this price, and then people stopped building new nuclear reactors because it became really unfashionable, and that led to the bursting of the 70s bubble. And then we had this trough from 1980 through to about the year 2000. And so here we had an oversupply of uranium combined with the megatons to megawatts program, which is where, after the Soviet Union broke up, a lot of their nuclear stockpile was converted into nuclear fuel as part of the nuclear disarmament program. And so that obviously then was a real negative effect on the uranium price. However, once the megatons to megawatts program went away, we found ourselves actually with a supply shortfall in uranium, and that was then exacerbated by some flooding of some mines in Canada, which then shut off quite a lot of supply of world uranium all in one go. And that then led to the 2007 uranium price bubble. However, that was fairly short lived, and then we had the Fukushima disaster, and we found ourselves around 2016 at a period of depressed uranium price. But that was then what set us up to this bull market, because a lot of the uranium miners had gone bankrupt and had shut off production because it just become, at these prices, it was just uneconomic for them to mine uranium. And that then did set us up quite nicely from this bull market from 2018 to 2022. So this has been characterized generally by an undersupply of uranium oxide, by the Sprott Uranium Trust coming in, and they've been hoovering up a lot of uranium from the spot market, which has then led to price increases. And also, generally, nuclear power has become quite fashionable all of a sudden. Most governments around the world are now going all in building new uranium plants because they see it as the way of meeting their net zero targets. So here I am, I've kind of doubled my money as is, and I've got to kind of decide, do I actually lock in those gains now, based on the risks and rewards going forward, or do I hodl for more? If I'm honest, when I first invested, I was hoping for some Bitcoin-esque action like this. But really, this seems to me to be more like a linear trend than an exponential trend. Actually, the big ramp up in 2021, at first that looked like some kind of exponential thing, but actually it does coincide with the Sprott Uranium Trust. We can see here that Sprott went in and actually bought about a third of the total amount of uranium being mined in that year. And so that does correspond quite nicely with this sudden jump up we got. And once these ETFs take uranium from the market, they then hold it. They don't intend to then re-release it onto the market. So that does kind of explain a jump up to me. But it's quite notable that the amount of money going into these ETFs has decreased this year. And although Anu Energy, they're a company being formed by Kazatomprom, they are actually promising to take £10 million off the market next year. All the same, this ETF activity seems to be more of a kind of new increased demand for uranium, but not enough to actually create, a exponential increase in the spot price. And so for me, it's obviously a tight market with a lot of volatility. But for me, it does seem more like a linear trend when I look at the price of uranium. I drew in red here an exponential trend, and we are kind of obeying that, but who's to know? You can't really say with any certainty if we're in a linear or exponential, and so I tend to default on a conservative analysis of it being more of a linear trend, which does actually tie in really nicely with Bank of America's forecast of $70 uranium next year. So here I look at the supply and demand dynamics of the uranium oxide market, and we see that the mining supply here isn't enough actually to meet reactor demand. And what's been happening is over the last couple of years is it's only really a slight mismatch, and the extra £30 million they need, they get from secondary supply or from the spot market. The spot market, I've already described what's going on with the ETFs. And so, yes, they are taking 20 to 40 million pounds, say, a year, but it's actually more like 10 to 20 million pounds this year. So, yes, that helps explain a linear pump up because of how they've affected slightly the dynamics of the market, but it's not enough for us to move. And so that leads to secondary supply. Now, this gets fiendishly complicated, and I'll go into detail in a moment. I've been looking at the World Nuclear Association data, and they are fairly clear that the secondary supply is expected to drop to around 7,000 tons of uranium equivalent per year, and that goes up to the year 2040. So, without having to go into all the heinous details, I think it's fairly safe to use them to say that the 22 million pounds which currently comes from secondary supply is going to reduce to half of that in the next 10 years. And so again, you have a slight shortfall, which does explain the Bank of America target in a controlled way, without having to go into all the details of all this stuff, which I'm going to do anyway in a moment. But really, the important thing is that the main message for me here is that yes, there is a slight supply demand imbalance, but not enough for us to move. I think it's best to be level-headed and say, look, we've doubled our money here off the tightness of the market and the things that have happened, but the $70 per barrel, but I've doubled my money here, so I can be happy with that. And the $70 per barrel Bank of America target looks kind of reasonable given the off takes here that we do have. Now, in terms of mining supply, this has actually been this was actually explained back in 2017 as being because actually at the 2017 prices or even the 2019 prices, it was actually not economical for half of the world's uranium suppliers to mine at those low prices. In this graph you see here in grey here, this is all of the world's mining resources, and as you can see, it just was not economic for them to mine at those 2019 prices. However, the situation now is that at $50 uranium, it's now economic for all of those mines in the world to start mining uranium. Now this isn't something that can happen immediately. It's going to take a year or so for all those to go online. But we are in a situation now where the mining supply can increase. But actually, the main miners, which are Kazatomprom and also Cameco, they are deliberately holding back on their mining. The main point being that if the price does start shooting up past $100, there is actually mining capacity there that will come online, and that will control the price to some extent. Now, the World Nuclear Association, they here have actually got the known nuclear demand against the known mining supply. And what we see is that actually, although there's a shortfall at the moment, as all this mining capacity starts to come online in response to the higher price, the actual demand is going to be met by supply as we get to around the year 2024 onwards. So my main point being that certainly in the next 5 years, really there's not going to be too much of a disparity between supply and demand that can't be dealt with on the spot market or from secondary supply. So really my conservative assumption, given of course that I do have the luxury of having doubled my money from this investment as we now sit, my basic premise here is that this is only a linear upwards trend, and we're looking at $70 uranium next year. And this is what I'm this is really my base case. I'm not really expecting a moon, and any kind of moonshot that will just be a nice thing to happen, but not really what I'm expecting to happen. I'm just expecting a continuation of linear growth to about $70 next year. Now, this, of course, is in contrast to a lot of the people you'll see on YouTube and Reddit and Twitter and stuff. There are a lot of people calling for uranium to go to the moon and stuff. And what I've found is a lot of their arguments relate to all the complicated stuff. So there's some really technical details here around secondary supply. And so these are now, it used to be 3 years ago, a lot of the people were showing you this slide. And actually, Yellowcake themselves were showing this slide when they were trying to get you to invest in them a couple of years ago. And of course, that is a clear reason for the price to go up, because it was not economically feasible to mine uranium. The problem is that the price of uranium has now gone up to where all of these mines can now produce uranium at a profit all of a sudden. And funnily enough, you don't see this slide presented anymore. If you look at the video I did back in 2020, well, my investment case has happened and I've doubled my money, so that's great. But the problem is the price is now set there where people can start mining and setting up mines to mine uranium. And then I've noticed the narrative shift to all of these secondary supply issues. The ETF demand story, well, that's actually diminished now to only to 10 to 20 million pounds. And you see all these people shilling these really complicated things. But when I go into that, I think it's best just to go on the World Nuclear Association assumptions rather than these really detailed things that sound really good, but probably aren't really going to affect the big picture so much. Certainly not enough for me to bank on them as my base case. Having doubled my money, it's a lot more sensible for me to adopt this conservative base case. So in terms of secondary supply, one big component of it is the civil stockpiles. All the countries, obviously, they have to have large stockpiles to make sure they've got enough to last a few years in case there's anything really bad goes on in the world. So one thing that could happen that could then lead to an acceleration in price would be if some ETFs and some hedge funds came in and started to seriously pile on ETF demand for uranium. That did affect the price, obviously, in 2021. Obviously, that's now turning into just a smaller trickle of demand that's not really doing what people thought it might a few years ago. But it does remain as a potential force, but not something that I want to bank on. Another thing would be if there was a sudden increase in people piling up their civil stockpiles. Now, there has been some of that in the US, quite notably. And of course, with the war in Russia, that then creates in a increasingly polarized world, that does create a pressure there where it is possible that you could have some civil stockpile building, which again could then affect the spot market. However, like I say, these are good positives that could happen. Not enough. I'm not convinced enough to affect my own base case. Like I've said, a lot of experts are coming on and then they're talking about nuclear reprocessing as a way of affecting the market. Okay, so I'll talk about the depleted uranium fluoride and reprocessed uranium and MOX, which is mixed oxide. So obviously, the utilities, they tend to buy the uranium oxide or yellow cake, and then they own it as it goes through each of the steps of conversion and enrichment, and then fuel fabrication, which are then made for the nuclear fuel rods to use for power generation. Now, in the nuclear conversion, the uranium oxide is converted into uranium fluoride, which can then be used for enrichment. And the conversion is actually highly controlled. It's only allowed to happen in 5 facilities at these 5 countries. There's quite a lot of conversion capacity. The price of converted uranium has shot up loads, much more than the price of yellow cake, since the invasion of Ukraine, because the market's starting to split. Because although we can still get converted uranium from Russia, obviously we're now trying to do it ourselves instead because of the long-term political issues with Russia. But although the actual price of converted uranium has gone up loads, it doesn't seem to have affected the longer. It doesn't really seem to directly affect the price of yellow cake, because we've actually got quite a lot of conversion capacity in France and the US and Canada. We're now basically using our own capacity up to full demand in response so that we can rely on the Russian capacity less. But from what I make out, the overall capacity that we have in the West is enough to kind of deal with our needs. And then the next stage after conversion is enrichment. And in nuclear enrichment, we start off with now actually this covers conversion and enrichment, but you start off with your yellow cake, which is 0.7% uranium, and then when it gets converted into the uranium fluoride and then enriched, so you've got more uranium 235, so that you then have the enriched uranium at 5% uranium 235, and this is the product, the enriched product, that then gets turned into nuclear fuel. And actually, historically, we've been doing something called underfeeding because we were relying more on Russian conversion, on Russian enrichment, and so actually the Russian enrichment was about half of the total world enrichment going on. Now what's happening is they're switching away from Russian enrichment, and instead all of these German, all these European, UK, and US and French enrichment capacity. Now we're actually, all that had been kind of being run at low capacity before. And now we're actually moving towards running it all at maximum capacity so that we don't have to rely on the Russians. And this has actually led to a situation where before we were underfeeding, which is where you use a higher energy cost. It means that you use less uranium or yellowcake to produce your fuel. And then you have what is called tails, which are depleted uranium stockpiles, which are, because you've been putting more energy in there, you use less yellowcake to end up with also less depleted uranium, which has a lower uranium 235 content at the end. Because we're now trying to use the Western enrichment capacity instead of the Russian, we're doing something called overfeeding. So there, it has a lower energy cost, but it allows you to use your limited enrichment capacity as much as possible to create as much nuclear fuel as possible rather than using Russian capacity. This uses more yellowcake, 0.7% uranium 235 uranium oxide, to create the same amount of enriched uranium that can be used in fuel rods, but at the expense of a higher tail assay. So you've got more waste, kind of, if you like, depleted uranium with a higher tail assay. Now, I've seen there's a lot of experts saying that this phenomenon that's going on is going to lead to an increase in the amount of uranium that's required. So people are saying that this underfeeding phenomenon that's going on could lead to an increased reactor demand, which could then increase the uranium price. But my position is that that is something that's so complicated that it's not easy for me to know how true of a thing that is. And so, given my situation of having doubled my money already, I'm quite happy to just assume a nice base case of $70 uranium, which is a significant increase. It's like a 3x from a couple of years ago. So, maybe that explains this increase, but I don't want to be hodling on if the uranium spot price starts dropping down quite a bit, because I'm listening to what these pundits are saying, hodling on for another like exponential increase. I think that it's much more sensible to assume a $70 base case. And so back to the secondary supply. And so with all the you actually get depleted uranium as part of all that process, and so there are big stockpiles of depleted uranium. So in the future, that could actually be something that could be used as an alternative to mining fresh uranium oxide. However, I think it's cheaper at these low uranium prices. It's actually cheaper just to use existing uranium, which is fairly cheap at the moment at sub $70, than using these big stockpiles of depleted uranium that exist. So the thing is, of course, though, all this makes a very complicated situation with the secondary supply. And of course, you also have, once the nuclear fuel has been used, it can be recycled, and you have reprocessing producing MOX and plutonium oxide. However, the sensible thing, I believe, is to go with the World Nuclear Association report and to make the assumption that secondary supply is only going to halve up to 2040. And so that this contribution here is fairly stable. The current dynamics, as I understand them from my look at the data here, my representation of the data here, the underfeeding thing, which a lot of the shills are saying are going to lead to uranium price mooning and stuff. If you go on Twitter, to me, I think I'm going to make the assumption that that's only just going to nicely create a nice added pressure on uranium demand. But I'm not looking at that impact to totally moon the price of uranium. And I just look at the dynamics here overall as a nice explanation for why we're having this nice linear trend up to the $70 uranium predicted by the Bank of America next year. No, if I see the price starting to go down, I don't think I understand the price dynamics enough not to sell, given that I've got the benefit of my investment doubling over the last couple of years. So here from the World Nuclear Association, we see how actually we've got all these factors which I've just described, which mean that we need a $70 uranium price to expect the mining requirements to be met. But really, in the next, yes, there's lots of nuclear reactors being built at the moment, but they take 10, 15 years to all come online. And you see here the grey line. This is the expected demand for uranium from all those new reactors. But as you can see, the demand doesn't come out until the 2030s, really. So with this World Nuclear Association data, we see here the expected demand for these new reactors. They've got a high case here as well, but you can see that the actual supply can meet the demand well up to the year 2030, really. So I think the current uranium price, looks reasonable for the next 5 years, say, but really you're not going to see serious upward pressures that could that could create this price bubble or $100 uranium plus. That's not going to happen for that real supply demand shortfall is going to be for more like 10 to 20 years time. So me, I've kind of set a stop loss here, and I'm hoping, which would be an 80% increase on my initial investment. So I'd like to sell half if that gets breached, but basically it will be like a trailing stop loss. So I want to kind of continue to trade this linear trend upwards to the $70 uranium next year. And that's what I'm going to try and do. I'm hoping I can follow this trend for as long as possible, but then I really want to sell it, and particularly if we get up here, want to sell it. It's a bit tricky because I'm tracking the uranium spot price, but then also tracking the yellowcake spot price and the yellowcake price, and I've got to kind of bear in mind that what's more important than the yellowcake price is actually what the spot price is doing, as far as I'm concerned. I've also got to bear in mind that the yellowcake price is now a 20% discount to NAV, and really I want to be selling when it's a premium to NAV, not when it's a discount to NAV. But still, I think this 80% stop loss here at £3.60 yellowcake price, I think that's a good prudent stop loss for me, because I think I've done very well. I don't think the upside can be as amazing as the pundits are telling us. So, I think it's good for me to sell half once I've doubled my money. But then, having de-risked my portfolio a bit, I do find in the long term, I do think it's kind of quite good to wait out like a 10-year time period here when there is this longer story. But the important thing is the real upside isn't now. The real upside is like more of a longer term story. So to summarize, the current supply and demand dynamics support the Bank of America forecast of $70 uranium next year. I think we're in a linear trend, which makes sense with the current supply and demand dynamics. The much shrilled mooning of the uranium price, I think that's something that's unlikely to happen, but nice if it does happen. I think it's good for me to bank half my gains if the moment that the current trend gets broken, because doubling my money is an excellent outcome anyway for a commodity bet. According to the data, uranium mining is now viable above 50 USD. So really, a true supply and demand disparity won't happen for 10 to 20 years. I'm going to bank half my winnings at 2x once this trend is broken. I still want to hold on to the rest as because uranium seems like a nice alternative to cash. The uranium market is totally unaffected by the world economic conditions, so I think it's quite cool to have some uranium in your portfolio. I think it's a great inflation hedge, and it's something that's not affected by the financial conditions of the world. So I think it's a great thing to have as part of your portfolio. So I want to hold longer term once I've sold half at 2x. You've got to remember though that there's always the risk of a new Fukushima happening. I think that net zero mania is so powerful a force at the moment that even if there was a load of Fukushimas happening, I don't think the impact will be as bad as it was last time. But you've always got to assume that there is like a nuclear disaster risk whenever you hold uranium, and I'll have to review that in the future, you know, in some kind of interval. So that completes my analysis for yellow cake, and I hope you found that useful. Please remember, of course, to go and check with your financial advisor first, though, before doing any gambling. And good luck with whatever you're doing. Please read the disclaimer and remember that prices can go down as well as up.